Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 3 of why structured investment vehicles matter in modern finance. Asset write-downs. SIVs heavily invested in mortgage-backed securities, which lost value rapidly during the crisis. This meant that banks holding or supporting these assets saw their own balance sheets shrink as they wrote down significant losses. The connection between banks and SIVs was like a domino setup. Once SIVs couldn't meet their obligations, banks fell next, and the effects quickly spread across the global financial system. Lessons learned. The collapse of SIVs taught the financial world harsh lessons about risk, transparency, and accountability. These lessons have shaped how financial systems are approached today. Here's what we've learned. Transparent reporting is essential. Before the crisis, SIVs operated in a shadowy part of finance. Their off-balance sheet status created a false sense of security. Now, stricter rules demand transparency, ensuring liabilities don't stay hidden. Liquidity management matters. The heavy reliance on short-term funding paired with long-term assets was a ticking time bomb. Post-crisis, firms have shifted to maintaining stronger liquidity buffers to avoid such mismatches. Over-leveraging backfires. SIVs were highly leveraged, magnifying their losses when asset values fell. This taught investors and regulators the danger of chasing high returns without considering risk exposure. Sponsor responsibility needs to be clear. The inability of sponsoring banks to fully anticipate SIV risks showed the need for tighter alignment between sponsors and the vehicles they support. Today, banks face rules that require them to better manage and disclose off-balance sheet obligations. Interconnected risks can't be ignored. The cascading failures of SIVs demonstrated how interconnected financial institutions are. Problems in one area can quickly snowball across the system. This has pushed regulators to monitor systemic risks more closely. The 2007-2008 crisis served as a wake-up call. SIVs showed that even complex financial tools must be examined for basic flaws. While they were designed for profit, their vulnerabilities revealed the cost of ignoring risk and oversight in pursuit of high returns. Current trends in structured investment vehicles. Structured investment vehicles, SIVs, have seen a shift in operation and perception since their role in the 2007-2008 financial crisis. Both regulatory and market forces have reshaped how these entities function today. To stay relevant, SIVs are evolving under tighter rules and adapting to a changing economic climate. Let's examine the latest trends shaping this space. Regulatory changes and compliance. Regulations surrounding SIVs have become more stringent in the wake of the financial crisis. Policymakers introduced new rules aimed at improving transparency and reducing risk. These reforms seek to create a safer financial environment, but they also force SIVs to adjust their operations. Key changes include capital requirements. Regulators now demand higher capital reserves for institutions tied to off-balance sheet entities. This ensures sponsors, like banks, can absorb potential losses. Enhanced reporting standards. SIVs must regularly disclose their assets, liabilities, and risk exposures. This step reduces the opacity that fueled past failures. Tighter oversight of short-term funding. Rules now limit how much short-term debt SIVs can rely on. This reduces liquidity risks tied to sudden market shifts. These compliance measures mean operating a SIV today involves additional costs and complexities. For instance, maintaining higher capital buffers often cuts into returns, making them less attractive to risk-averse investors. Yet, these restrictions are a necessary trade-off to avoid another collapse. At the same time, not all countries have implemented the same rules. This inconsistency creates challenges for SIVs working across borders. While one market may allow certain practices, another may outlaw them entirely, prompting SIV managers to tread carefully. Does this mean the high-risk, high-reward nature of SIVs is gone? Not entirely. It just requires sharper management and a willingness to adapt to the new regulatory landscape. Market adaptation and innovations. SIVs today must respond to a financial world that looks very different from the early 2000s. Shifts in global markets. interest rates, and investor priorities have led to new strategies and tools. While some traditional elements of SIVs remain, innovation is key to their survival. Here's how SIVs are adapting. Focus on sustainable assets. With growing demand for environmental, social, and governance (ESG) focused investments, SIVs are integrating these into their portfolios. For example, investing in renewable energy-related bonds can attract ESG-conscious investors while offering solid returns. Diversifying funding sources. Instead of relying heavily on commercial paper, SIVs are broadening their funding mix. They now use instruments like asset-backed securities or longer-dated notes to reduce dependence on short-term borrowing. Leveraging data and technology. Advanced analytics are playing a bigger role in portfolio management. SIV managers use data tools to predict market shifts and optimize asset allocation. Technology ensures they can respond quickly and mitigate risks effectively. Reducing leverage. Modern SIVs operate with less debt than their predecessors. This move keeps them more resilient during market downturns, even if it slightly lowers potential returns. Building liquidity reserves. Lessons from the financial crisis led to better liquidity management. SIVs now maintain liquid asset reserves to cover short-term obligations during market stress. These strategies showcase how SIVs are staying competitive in today's economy. By embracing safer practices while exploring new investment opportunities, they aim to protect profits without repeating the mistakes of the past. Ultimately, SIVs are walking a fine line. They seek growth while addressing the risks that once put their survival in question. Whether they succeed depends on their ability to remain flexible in an ever-changing financial world. Conclusion and future outlook. Structured investment vehicles, SIVs, have clearly shown their potential and their pitfalls in the world of finance. While they offer opportunities for strong returns, they also come with significant risks tied to funding gaps, market volatility, and regulatory shifts. As the financial world evolves, understanding the trajectory of SIVs is important for investors, regulators, and market participants. Let's take a look at what the future holds for SIVs. Key lessons from the past. The history of SIVs is a blueprint of successes and failures. The 2007-2008 financial crisis exposed weaknesses, particularly their reliance on short-term funding and a lack of oversight. These failures brought necessary changes. Tighter regulations now dictate their operations. Transparency requirements help clarify their financial positions. Emphasis on liquidity buffers reduces risks tied to funding mismatches. The takeaway? SIVs must remain cautious while adapting to market demands. The lessons of the past serve as guardrails for shaping their future. Current trends shaping the market. SIVs are evolving to stay relevant in today's reshaped financial ecosystem. Some critical trends include conservative risk management. New models favor reduced leverage and diversified asset allocation to limit exposure to economic shocks. Focus on sustainable investments. Incorporating ESG-focused assets appeals to modern investors seeking ethical returns. Use of technology. SIV managers are leveraging data analytics for smarter decision-making and risk forecasting. These adjustments reflect how SIVs are trying to meet investor expectations while avoiding the traps that led to past failures. Challenges ahead. Despite progress, SIVs face ongoing challenges. Regulatory uncertainty. Rules vary widely across regions, posing barriers for global operations. Market volatility. Shifts in interest rates or liquidity availability can still threaten profitability. Balancing growth and safety. Higher returns often mean higher risks, forcing managers to carefully weigh their strategies. These issues require constant vigilance and adaptability if SIVs hope to thrive in modern finance. Opportunities looking forward. For SIVs, the future comes with opportunities to rebuild trust and expand their role. Collaborating with regulators can create consistent and predictable oversight. Offering products tied to growing sectors, like renewable energy, could open new revenue streams. Developing new funding strategies to minimize liquidity risks may make SIVs more stable and appealing. The focus is clear: innovation without repeating prior mistakes. A balanced approach could help SIVs regain credibility and draw investor interest in the years to come. What's next for SIVs? That depends on how well they navigate tightening regulations, market complexities, and shifting investor priorities. For now, their evolution is a work in progress, and one worth watching. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.